Welcome to the tutorial of bookkeeping mga ka-students. Today, we will tackle about adjusting. Before we proceed on how to do adjusting entries, don't forget to like, share, and subscribe to our YouTube channel and click the notification bell for more upcoming videos. So let us first define what is adjusting. So adjusting entries are entries made prior to the preparation of financial statements to update certain accounts so that they reflect correct balance as of designated time. The preparation of adjusting entries is the fifth step of the accounting cycle. Adjusting entries are journal entries which are to be recorded in the general journal. So the primary purpose of an adjusting entry is to update the balances of some accounts and to split a mixed account into its real and nominal components. Errors and omissions are likewise corrected and recorded in the book of the business. The adjustments are made to conform with one of the governing principles of accounting, which requires the proper matching of revenues and expenses. This is the matching principle. So in preparing the adjusting entry, we observe the cut-off date or cut-off period. This is the period observed in preparing the financial statements. This is the dividing or boundary date segregating each of the accounting period. So at the end of the accounting period is the cut-off period. If a business uses an annual calendar accounting period, the cut-off period or date is December 31. So adjustments are grouped into accruals, deferrals, provision for doubtful accounts, provision for depreciation, and inventories. So accruals of income and expense. So in accounting, the term accrual or to accrue means to recognize an expense that is already incurred but not paid, or an income that is already earned but not yet collected. So accrued expense is an expense that is already incurred but is not yet paid when the accounting period ends. Since we normally record an expense when paid, any expense that is incurred but not yet paid is presumed and understood to have not yet been recorded unless an adjusting entry is prepared. Therefore, the purpose of the adjusting entry is to record the expense and recognize the corresponding liability. So the pro forma entry is blank expense, and that our credit side is also accrued blank expense. So to illustrate, salary of an employee for the period 16 to 13 December 20A was not yet paid. So the accounting period ends on December 31, 20A. The amount was 3,000. So adjusting entry on December 31, 20A as debit salaries expense, credit accrued salaries expense with an amount of 3,000. So effects on financial statements. If no adjusting entry is prepared, the effects are as follows. So in income statement, since the expense will not be recorded, total expense at the end of the period is understated. Deducting a smaller amount of expense than it should have been will overstate the net income. In balance sheet, since the liability will not be recognized, total liabilities reported in the balance sheet is understated as well. And owner's equity account is overstated because the net income close to capital is also overstated. So accrued income. So an income that is already earned but is not yet collected when the accounting period ends. Since we normally recorded income when cash is received, any income earned and no cash is received is presumed and understood to have not yet been recorded unless adjusting entry is prepared. So the purpose of the adjusting entry is to record the income earned and recognize the corresponding collectible or receivable account. So the pro forma adjusting entry is accrued blank income in the debit side, and then the credit side blank income. So to illustrate, the rental of a tenant amount to 1,000 pesos for the month of December was not yet collected when the period ends on December 31, 28. Since the rental is earned as of December 31, it should be recorded though no cash is received yet. So in adjusting entry on December 31, 28, so debit, accrued rent income, credit, rent income with the amount of 1,000. So, the effects on financial statements. In income statement, since the rental income will not be recorded, the total record income as earned during the period is understated. Thus, net income is understated too. In balance sheet, the receivable account accrued rental income will not be recognized. Therefore, asset will be understated. Likewise, owner's equity is understated because the amount of net income that is close to capital is also understated. So, deferrals. So, prepaid expense, this is an expense that is already paid but not yet incurred. So, this is the opposite of accrued expense. So, there are two methods of recording prepayment. These are the expense method and the asset method. Regardless of which method is used, the amount of prepayment will become a mixed account at the end of the period. Thus, an adjusting entry is necessary to split the asset and expense account, which are the components of this mixed account. So, guide in preparing adjusting entries on prepayment. So, 1. If an expense method is used in recording prepayment, the account debited upon payment is the expense account. In your adjusting entry, go for the opposite. Thus, credit the expense account and debit the asset account equivalent to the prepaid or unexpired portion of the prepayment. So 2. If the asset method is used in recording prepayment, the account debited upon payment is an asset account. In your adjusting entry, go for the opposite. Thus, credit the asset account and debit the expense account with an amount equivalent to the correct expired or expense portion of the prepayment. So to illustrate, September 1, 28, the business paid an insurance premium covering the period from September 1, 28 to September 1, 20B in the amount of 3,600. The account period ends on December 31, 28. So, regardless of which of the method will be used in recording the above payment, the 3,600 will become a mixture of asset and expense at the end of the period. So, upon payment on September 1, 28, in expense method, the debit side is insurance expense and credit cash with the amount of 3,600. And in asset method, the debit side is prepaid insurance 3,600 and credit cash with the amount of 3,600 as well. So in adjusting entry on December 31, 20A, prepaid insurance is the debit side and credit insurance expense with an amount of 2,400, which is the asset or prepaid portion of the 3,600 amount. So in asset method, insurance expense is the debit, credit prepaid insurance with an amount of 1,200, which is the expense or expired portion of the 3,600. So take note that both methods arrive at the same account balance after the adjustment. So the effects on financial statements under expense method: if no adjusting entry is prepared, the whole amount of 3,600 will be charged to expense when in fact 2,400 is prepaid portion or asset. Since the asset portion could not be recorded without the said adjustments, expense is overstated and asset is understated. If expense is overstated, net income is understated as well, and owner's equity is also understated because the amount of net income close to capital is understated. Therefore, in income statement, expense is overstated and net income is understated. In balance sheet, asset is understated and owner's equity is also understated. So, effects on financial statements under asset method. If no adjusting entry is prepared, the whole amount of 3,600 will be charged to asset when in fact 1,200 is expired portion or expense. Since the expense portion could not be recorded without the said adjustments, expense is understated and asset is overstated. If expense is understated, then net income is overstated and owner's equity is overstated because the amount of net income that is close to capital is overstated. Therefore, income statement expense is understated and net income is overstated. In the balance sheet, asset is overstated and owner's equity is also overstated. So pre-collected income. Pre-collected income, this is an income already collected but not yet earned when the period ends. This is the opposite of accrued income. There are two methods of recording pre-collected income. These are the income method and liability method. Regardless of which method is used, the amount collected in advance will become a mixed account at the end of the period. So thus, an adjusting entry is necessary to split the income and liability accounts, which are the components of mixed accounts. So guide in preparing adjusting entries on pre-collection. 1. If income method is used in recording pre-collection, the account credited upon receipt of cash is an income account. In your adjusting entry, go for the opposite. Thus, debit the income account and credit the liability account with an amount equivalent to the correct unearned portion of the pre-collected income. 2. If liability method is used in recording pre-collection, the account credited upon receipt of cash is a liability account. In your adjusting entry, go for the opposite. Thus, debit the liability account and credit the income account with an amount equivalent to the correct earned portion of that recollected income. So to illustrate, on October 1, 20A, the business collected 12,000 from a tenant representing an advance collection from building rental for 1 year period. So, regardless of which the method will be used in recording the above pre-collection, the 12,000 becomes a mixture of income and liability at the end of the period. So, upon payment on October 1, 20A, in income method, the debit is cash and the credit is rental income with an amount of 12,000. And in liability method, the debit is cash and the credit is an earned rent income with an amount of 12,000 as well. So, in adjusting entry on December 31, 20A, under income method, debit rental income, credit unearned rent income with an amount of 9,000, which is the unearned portion, the unearned income portion of the 12,000. So, in liability method, unearned rent income is the debit and credit is rental income with an amount of 3,000. So this 3,000 is the income earned on that year. So, effects on financial statements under income method. If no adjusting entry is prepared, the whole amount of 12,000 will be charged to income when in fact 9,000 is an earned portion or liability. Since the liability portion could not be recorded without the said adjustment, income is overstated and liability is understated. Owner's equity is overstated as well because the net income close to capital is overstated. Therefore, in income statement, net income is overstated and in the balance sheet, liability is understated and owner's equity is overstated. So, the effects on financial statements under liability method. If no adjusting entry is prepared, the whole amount of 12,000 will be charged to liability or unearned when in fact 3,000 is earned portion or income. Since the earned or income portion could not be recorded without the said adjustments, income is understated and liability is overstated. And owner's equity is understated because the net income close to capital is understated. Therefore, in income statement, net income is understated. And in the balance sheet, liability is overstated and owner's equity is understated.